And for the LATAM update, we have Daniel and Enrique today.
Yeah, thank you for the introduction and hello everyone. Well, I would like to start with the first topic of the presentation related to Mexico and the MLI provisions. Just as a brief update related to this topic, the Mexican Congress approved or ratified the MLI provisions in Mexico in 2022. So we expect that the tax provisions related to this matter will be enforced in 2024. So in this case, as you know, the MLI provision has certain rules related to PPT. And for that reason, it is important to analyze and to review with our clients the structures in which they have holding companies that receive payments related to interest and royalties, in order to know if these PPT rules would affect the double tax treaty benefit application because of the substance and economic activity of the holding companies. Related to the next topic is for reportable schemes. As you know, there is a list of transactions in Mexico that if the transaction fall under this list, they must report it to the tax authorities. They must inform to the tax authorities the nature of the transaction and also the characteristics of the transaction for their review. And it is important to review this jointly with our clients, because that is not only an obligation from them, but also is an obligation for us as a tax advisors when we participate in those transactions or in those schemes. So in order to avoid any penalties related to this topic, we suggest to review this jointly with our clients. Related to the next topic, in starting the year 2021, there are certain rules related to transparent vehicles or entities, because they are going to pay tax in Mexico as a source, or because of the source of income, or in some cases they would pay tax in Mexico as if they are residents, according to the characteristics of each vehicle or entity that are considered transparent. So for that reason, it is important to review with our clients the structure in which there are transparent vehicles or transparent entities, in order to know the tax effects that the payments performed by the Mexican residents are going to have in these structures in which we have this kind of transparent entities or vehicles. Also, it's important to analyze if there is a specific provision related to how the double tax treaty will consider these vehicles. Otherwise, we need to consider the local provisions. We could result in a tax in an additional tax paid in Mexico by those foreign entities. In addition, it is important also to review all the foreign payments performed to related parties, in order to identify if there are direct or indirect payments that would end in a low tax jurisdiction, because that would end in or that would lead for the Mexican payers a non-deductibility of such expenses. So for that reason, it is important to analyze the payments performed to foreign related parties, not only the direct payments, but also the indirect payments, in order to have the full picture and in order to avoid any non-deductibility for our Mexican clients. So if we move to the next slide, please. Thank you. So related to Costa Rica, there is a similar provisions of PPT for the MLI. However, in Costa Rica, the MLI is in force for the fiscal year 2023 in terms of the transactions performed between Costa Rica and Spain. And also similar to Mexico, it will be important to review the substance of those foreign holding companies, in order to know if these PPT rules, or in order to determine if these PPT rules would affect the double tax treaty benefits that the clients are applying right now. Related to foreign payments in Costa Rica, it is important to mention that the tax authorities are considering, or the tendency for the tax authorities is that they are considering all the payments related to software as royalties, and trying to apply a withholding tax as if they were royalties and not software payments, without considering the definition in the double tax treaty and also the OECD commentaries. So for that reason, it is important to review this kind of foreign payments, in order to support the clients to perform a defense file to prove to the tax authorities that this is only a software payment and not a royalty payment. And last but not least, what we have in Costa Rica, as you may know, they are in the countries in the gray list of the EU because of the exemption of the foreign passive income. But we have been informed that the government in Costa Rica is analyzing a tax reform for fiscal year 2023 in order to levy taxes in those foreign source income, and in order to be in line with the global tax recommendations. So I will pass the word to Enrique for the next topics.
Thank you, Daniel. So moving to the section on South America, to start off, Argentina. Quick message in respect to Argentina. So if you have clients operating in the country, by this point in time, you might have heard about the FX restrictions imposed by government a few years ago that impact, for instance, the ability of clients to get cash out of the country. So despite the difficulties of operating under these currency control rules, there are also opportunities that your client needs to know about to restructuring the business and trying to make their life easier in the country. And to that point, the KPMG tax team in Argentina has been assisting clients with tax, legal, and FX reorganization. So to the extent that you want to know more about the possibilities and explore the opportunities, please reach out to Violeta Lagos and her team at KPMG in Argentina. They will be happy to assist with that. Moving to Brazil, the first topic, Provisional Measure 1152. It basically introduces the new legislation on transfer pricing in Brazil. So we're moving from a scenario where we have, for instance, predetermined fixed margins to a scenario where assets, risks, and function analysis matter, and not only matter, but will be pretty much the backbone of our legislation. So we are moving to a scenario where we're pretty much aligned with the OECD guidelines. And despite we are talking about a transfer pricing legislation, it pretty much covers transactions within the same group. So if we're talking about import of services, goods, financial transactions, move of RP, corporate reorganizations, you name it, it's worth discussing the topic with your clients because it's a huge change to what we have now. And despite it's still subject to approval from Congress, clients may opt to apply this legislation for this year, but only after approval from Congress, which we expect will happen. The legislation will be mandatory for 24 onwards. So moving to the second topic, deductibility on cross-border payments. The name pretty much speaks for itself. So not only Provisional Measure 1152, but another legislation that is already on force introduces changes to the limits on deductibility payments of cross-border payments, sorry. So if you have clients with subsidiaries in the country, and these subsidiaries are making royalty payments to abroad, be it clients on the digital economy or other segments, they should revisit the limits they are subject to because of the changes I've just referred to. Third bullet, Brazil signed in November last year, a double tax treaty with UK. And what happens is these, differently from any other treaty signed so far with Brazil, this treaty reduces the withholding tax imposed on Brazil on the import of services. So if you have subsidiary in Brazil importing services from clients or service providers in the UK, the statutory rate of 15 is reduced to 8% and will be further reduced to 0% once it's been 4 years the treaty with UK has been in force. And it's important to pay attention not only to transactions with UK, but also with those jurisdictions that have a treaty with Brazil, and the corresponding treaty has a most favorable nation clause, because they may also benefit from this reduced rate with the treaty with UK. So in that case, we are talking about Spain, Mexico, Sweden, and other jurisdictions. And finally, tax reform. This is a topic that's been there forever, but now it has gained strong momentum once again because of the government that has been recently enacted, This is a top priority item in their agenda. And despite there's been no concrete draft made public so far, the message that's been conveyed is that it's going to be a two-phased approach reform. So it's likely that in this semester we'll have news on the VAT reform, and on the second semester we'll have more concrete news on the corporate income tax reform. So quite exciting times as far as tax in Brazil is concerned. A lot of news. So to close out the South America section, Chile. So from January 23 onwards, services rendered, provided, or used within Chile will be subject to VAT tax. There are a few exceptions aside. So for this reason, it may impact a lot of transactions, and your client may want to review ongoing agreements and ongoing transactions that involve payments to and from Chile, because they may be impacted by this new provision. And the reason why it's worth making sure, reassessing their transactions is first to make sure that they are not, or they are within one of the exceptions. If they are not, to make sure that they are complying with the new legislation, and of course, from a practical perspective, to make sure and assess what the impact of this new legislation is going to be to their specific case. That would be all from the South America region. And that being said, I'll hand it over to Sunny.